All right. Happy New Year. Hope everybody had a good holiday. And for those of you who are joining us for the first time, and I'm happy to say there's a number of you, welcome. Welcome to what we do every week. And a little bit later than usual, 5 p.m. I don't know what everybody thinks. I wouldn't mind doing it at 5 o'clock on Tuesdays, Eastern time instead of 4, but let us know what you think. We've done it at 4 for a while, but maybe the extra hour would be helpful for some folks. Uh, I'm going to start this year with one of my favorite expressions. I think it was actually a quote from one of the Apollo 13 astronauts, and it was in the movie. I never forgot it. They were getting ready to go, first manned trip to the moon, and I think it was Alan Shepard who said, "Light this candle." And I feel like this year is going to be, well, like the kids say, lit. I think it's going to be lit, but I think a lot of things are going to light up. Uh, and look, I don't make a habit out of predicting the future. Like Yogi Berra says, predictions are difficult, especially about the future. So, but what I do think is that, kind of like I said, if you happen to see my Seeking Alpha article previewing this year, it was called "The End of the Innocents." Bruce Hornsby song, one of my favorite artists. And last year, I think that a lot of stuff just kind of went. First year of a new U.S. administration, a lot of stuff happening. The tariffs were a threat, then they weren't. Inflation was a threat, and then it wasn't. Employment, well, it's in trouble. Maybe it's not. AI is overblown. Maybe it's not. I mean, AI is going to change our lives. The only question is it also going to have a period in which we're going to have to adjust to fewer people being gainfully employed as they retrain and all that? So there's a lot of room for disruption, and I'm going to cover some of that here in the weekly roar, and then going to go on and focus as I think we're going to. And we're trying to set a tone for this year, and a couple of things I mentioned in the weekly. But one of them is, this group. First of all, as far as you're concerned, and I'll reiterate this because sometimes I think it gets lost, especially, we had new members coming in, things like that. This is your group. Like it's called, and if you're with us, through the Substack service, post Seeking Alpha. I mean, it's Sun Garden Investors Club on Seeking Alpha. Okay, so you're part of a club, and if you're with us through Substack, then it's ETF yourself. It's about listening to me, reading my stuff, asking questions, and then figuring out how to apply it yourself, how to map it on to however you are as an investor. And so that's why, as the year went on, I started doing less like, hey, I like this stock. I mean, I didn't do a whole lot of that to begin with. But here's what I think we have figured out going into this new year 2026. Not only because the markets are such that they're all zigging and zagging together, and we talk about that all year, but I've got some examples today. But in addition, uh, what I've come to realize 6 years now after we sold our advisory practice, retired, and came right back as a research company, and now doing this through a couple different venues, Substack and Seeking Alpha. What I figured out is that no matter how much I would have thought otherwise, everybody has a different thing they want to get out of this. When we ran a client base, It's about 80 million under management, a boutique firm. I managed 3 billion at one point for a bigger institutional type planning firm. But when it was, Dana and me and our staff running an investment advisory firm, fiduciaries, the whole thing, we had like 30 clients, 80 million under management. So it was a high net worth client base. But we knew what those 30 people wanted, or 30 families, and got into the next generation and all that. But it was very, boutique-y, clubby, if you will. And uh, with this service, we've gone through a few iterations, and all with the idea that, okay, is there a common denominator? And the only common denominator, I think, is really much more important than stocks, bonds, ladders, collars, whatever. The common denominator is everybody wants to learn, and everybody, I think, realizes that there's things that they don't know that they'd like to, and they're all going to learn a little bit differently. Uh, and that there's probably things that, like, you don't know what you don't know. And I include myself in that, except that here I'm the leader, and that's why a lot of times you'll hear me thinking through something or experimenting with something. I mean, I try to replicate as much as I can in this hour every week what I'm doing, a little more prepared, but what I'm doing all day. I'm looking around. I mean, investing, people try to cookie cutter it, but you can only take that so far. So, if there is a stock, an ETF, market questions, whatever, I mean, bring them on, throw them at me. And it doesn't have to be here, especially if you're listening on a recording, which many people do. But we've got a chat at Seeking Alpha. I believe, got a chat now in the ETF Yourself on Substack. We also have, um, I mean, most of you have our email, and if you don't, easy to ask us, or just go to the site, you'll see it. So, let us know. And instead of me saying, "Oh, hey, here's 100 stocks," I mean, I'm not using that many stocks, and it's not because I wouldn't love to. It's because I don't see any alpha in it. All I see is beta running up and down. And I cover a little bit of that here. So think of it this way: the more you drive what you want to get out of this club, uh, then, you know that you're going to determine that, because I can speak to anything. And sure, I'll do run throughs of different stocks. I mean, just got a question, any stocks you're looking at? Honestly, I mean, a couple of the financials look okay, but of course, those chips have already sailed, Goldman, JP. I mean, if you look back at, some of the stuff I've done before, in recent items, recent weeks. But I'm actually, because of course I still do write about, stocks, but usually it's less about what am I doing in my own portfolio. It's more about observations. But most of what I do is macro now. Um, but as an example, what I'm going to be doing, probably tomorrow, I'm going to chart the entire S&P 500. And I'm happy to say that I've been doing this long enough, charting for 40 years now, that uh, I'll get through them really quickly because I know exactly what I'm looking for. And as opposed to in the past, where people would say, uh, "You're gonna you're gonna have, um, all these different stocks." The fact that they're all moving in sync makes it so that, as an example, and I'll cover Amazon, but if Amazon is going up, there's a good chance there's 100 other stocks that are going up with it. There just isn't a lot to distinguish. If you're a trader, that's a different story because you have earnings, et cetera. SanDisk had a huge day today, apparently. I mean, I haven't looked at that one forever. But I'll see it when I go through the 500 stocks. I will I will see patterns, and I'll do something for Seeking Alpha. I'm sure I'll give you folks, some idea too if there's something that's not in the article. Uh, but that's the thing. I feel like going into 2026, and I'll get to the weekly here. Uh, it's not that people are overthinking it. It's that I think that we've been so brainwashed for so long into thinking that you have to go with narratives and that individual stocks are, I mean, they can be very effective, like I was saying, but they're overrated. They're overrated as investment vehicles. I hate to say it. So anyway, that's my kind of opening salvo for 2026. And but please, ask questions. Going to do a lot of portfolio construction work this year because just like our motto over at Seeking Alpha says for the club, I mean, we can give you a fish, and I'll do that all day long. Just ask. I'll answer the questions here, ask in the chat, etc. But uh, the thing that nobody is teaching, and thus nobody is learning, and they're wide open to disappointment the next time the markets are not friendly, which I think is going to be sometime this year. I just don't know when. When when you get to that point, um, people have to be prepared, and they have to think of this. Investing has to be thought of in terms of you're putting a puzzle together, or you're putting a team on the field, we'd like to say. And if you got weak links on the team and you don't figure it out until you've just given up the game-winning touchdown, that's a problem. And I think that's going to happen to a lot of people during 2026, um, because there's certain things that are just going too far. And if I'm wrong, great. We'll just keep making money, trading ideas, and whatever. Okay. All right. So let me see. Let me see. Let's go through and talk about. Um, I'm gonna skip some of this stuff. I'm just gonna pick out a couple things here. So I talked about it. Market's not, certainly not cheap. The 10 year hovering 417. I mean, that's been very stubborn here. People are so concerned that not concerned. I guess they're looking forward to rates falling. I'm not so sure they're going to fall. And if they don't fall, I can't think of anything better. And this is from personal experience. This is why I have a bond ladder, because I want to lock in 4.5% to 5% if you go out long enough in treasuries, in zero coupon treasuries, uh, where my proverbial example is, okay, you take 50 cents on the dollar, and it's going to mature for 100 if you're buying, I don't know, 14, 15-year bonds, okay? And you can hedge interest rate risk, and you can capitalize if the bond prices go up and rates go down. You can win either way with that. But the fact is, as opposed to sitting in cash wondering what should I buy next in the stock market, you lock that away, and you know that a portion of your money is getting a strong fixed return that you can hedging interest rates. To me, there's nothing better as an anchor, because then you can be a wild man or a wild woman or a wild person. Okay, you can do so much more without having to worry that, oh boy, if the market's down 40% and I'm 95% in equities, I'm going to be down 38%, but I'll probably be down more because I have some high beta stocks. And before you know it, half your money's gone. I mean, I've lived through this 3 times in my career. So anyway, let's go into some of the detail here. I start with treasuries because I think it all comes down to treasuries. If you're looking for the next super stock or whatever, good luck to you. But the amount of risk doesn't mean it won't work out. The amount of risk you're taking in the stock market these days is at a historic, nearly all-time high. And that does not mean it's going down. It just means that the risk is that the down could be really, really severe and punishing. At the same time, as I'll be writing pretty soon, we got a chance for a melt up. We're not there yet because the market's gone nowhere for going on 2.5 months now. Look back to October 29th, I think it was. I have a chart here. Nothing's going on. Nothing. So let's go through a couple of these because I think people tell me it's helpful when you have a little bit of color on this, whether you've read it or not. And we put it out usually a little bit before this meeting. So in the red here, this is where the yield curve was a little over a year ago, end of 2024. Very flat. Okay. You could get as much for T bills as you could going out this way. Well, now, I don't know if you see here, okay, but you're at 1, 2 year, 3 year, okay, but then it really starts to rocket higher, okay? So if you're building bond ladders, this is kind of the sweet spot right now, okay? And at the same time, still getting a decent yield on, Bill, part of the 2 ETF portfolio. So that works out pretty well too. Rates have gone down, but short rates have gone down quite a bit. Long rates are also down, except for the 30 year. You see this? Why is the 30 year the only one pretty much that's up, maybe 25 to 30 year? Because people are worried about not the solvency of the United States, but the ability of the United States to pay its own debts back without increasing inflation. I didn't mention the I word, and I don't mean ISBITs. I mean inflation. And probably going to be talking about that a lot in the early part of this year. We'll see when economic data catches up and all that. But inflation is stubbornly still here. I don't think it's dropping to 1% or 2%. I don't know if it's going to skyrocket either. But remember, the issue that consumers have is not the 2 to 3 to 4% inflation rate in a particular year. It's the fact that since the pandemic, if you add up all the years compounding, it's like 27%. So your average basket of goods that cost you $100 in 2020, think is costing you $127 now. And people feel that. And that's what creates this so-called K-shaped economy. And, where you've got a lot of folks at the top with a lot of money, and you've got a lot of people that aren't participating at all. So anyway, this, I mean, to those of you who are more equity inclined, which I think is most of you, I mean, if the stock market feels like it's doing really, really well, stop and look at this chart. Okay. It's not doing poorly, it's just doing nothing. But we conveniently forget about this. And, when you go 2.5 months with not a whole lot going on in a lot of these indexes, in particular, these were the market leaders. Okay. Top 20 stocks trailing the pack. If this persists, and the Nasdaq's right there with it because they're very similar. If this persists, okay, there may be a way to make money in the U.S. stock market and buying individual stocks, but it's not going to be the same names that led last year. And you can see that the Dow, and it's really only been recently, has kind of peeked its head up here. The Dow is threatening to do very well relatively. But I want you to also look at this and say, okay, I mean, how many different equity ETFs does one need? And if you do have a couple of stocks that are outperformers, the problem we have right now, I'm going back to some basics here, because first show of the year. When you when you have markets that are this correlated, it doesn't mean that you can't find something that does well for a little while. The problem is finding something that does well for more than a little while without a severe pullback. You can even think about, and I'm happy to chart these, got my charts ready to go. But uh, I mean, I think about the last couple of years that Nvidia has had. Oh, it ended up doing fabulously well, okay, over time. But it's also had these long stretches where you just didn't make a lot of money. And you have to decide, I think, as an investor, are you going to deal with the double-edged sword that is, I buy it, I hold it, and when I look back now, I say, Nvidia was great. Or does it become Cisco in 2000 to, I don't know, 2023 or something, went like 22, 23 years, where from the peak to where it was more than 2 decades later, after being basically the Nvidia of the dot-com bubble, the equivalent, went nowhere for 20 years. And I mean, I don't know if some of these, big fellas at the top of the indexes are going to do that. I just know there's going to come a point in time where they're going to have a very long drought. And that's okay if you are investing. But I think what a lot of people do is they try to look at every dip and say, oh, that's the one. Okay, I can buy in now. Okay, or just get on board. And, I mean, there is so much rear view mirror investing. We look back and we see what we just passed, and that's all we think about. And I'm not saying it won't work out. I'm saying it's really freaking dangerous. Okay. And I've seen it for the better part of 40 years professional investing. Yeah, 30 years professional investing, 40 years charting. Okay. So the Dow, look, this is not necessarily a new bull market, okay, especially where we've come from, but it's at least not bad. If it's not bad, then maybe it has a chance to be good. And it's peeking its head up here. I don't know if that's just a few stocks outperforming. Remember, all these indexes are sort of concoctions of stock weightings. Okay. Uh, so the Dow is not uh, dominated by Mag 7, it has several of them in there. But what dominates it at this point, frankly, is Goldman Sachs and a few others. It was United Healthcare. And I'll tell you what happened there, I guess, if you follow the market. Okay. United Healthcare was the largest holding in the Dow. It was like 10% of the Dow, and then fell out of bed. Well, Goldman's there now. Now, if earnings aren't good for the banks in another couple of weeks, then you'll see the Dow in trouble. Again, I'm not predicting the future. I'm also looking at the possibility that you could get just a total liftoff here. In fact, I've got an article that's kind of in the working stages now. Dow's getting close to 50,000. I'm like, 50,000 could get you 60,000, but it could also get you 30,000 by next year. That's the cyclicality of markets, and they do not wait for us when they decide they're going the other way. So look, longer term view of the Dow here, weekly for 4 years. Okay, it looks good. It looks okay. Does it look like long term buy? Absolutely not. Does it look like it could continue doing what it's doing? Yeah. Okay. All right, and I'm thrilled. All the questions are piling up. I'm gonna rifle through them, as soon as I finish this. All right, so I added a little bit to the Bitcoin position in the 10 ETF portfolio. That was great for a day, and then today it pulled back. Par for the course with Bitcoin. It's notoriously difficult to chart. What do I see here? Uh, I see a possibility. Okay, this is not a chart I'd normally be like, oh, I'm right in, but I see a little bottoming in a familiar area, and I see the PPO, my favorite momentum indicator, getting ready to maybe cross through here. So if it can just have this be a little check back and fly in and rise above this recent uh, temporary high here, which is made a couple of times, you got some room. You got some room. I mean, you could, I don't know if it'd go 20%, but 10% would be a lot easier here than it would be in almost anything else in the 10 ETFs. So that's why I added, to the Bitcoin, and maybe I'll do it again. We'll see. All right. I'll timestamp this one. The 10-year Japanese government bond. If you follow global markets, if you're an institutional type, if you know all the names of the people on Bloomberg just by hearing their voices, okay, then um, I feel like I should be saying, then you might be a redneck, like the great Jeff Foxworthy, but I don't mean that. You might be somebody that gets a little freaked out when you see Japanese interest rates going to here. Was zero, is now over two. Read up about the carry trade, the yen carry trade, the Japanese yen carry trade, Google it, AI it, etc. Learn about it. Because if that thing unwinds any more than it has, then it won't matter what stocks you own. It won't matter what sectors you own, and it won't matter what ETFs you own, because they'll all be going in one direction, and that will be flushed down. Again, I'm a risk manager. I'm not trying to predict gloom and doom. What I'm trying to do is make it so that everybody starts the new year with, hey, let me make sure my behind is covered, and then let's go and make some money. Okay. The only reason I can maybe think about upping a Bitcoin position or something like that is because I have a lot of protection in that portfolio, as I'll cover. Okay. And let's see, Roar score stays the same, but I want to be careful here. Okay. I think sometimes this gets a little bit misinterpreted. A score of 10, this is for a very conservative portfolio. If I were to say, okay, what is the actual quantitative Roar score? It's a little closer to what it would be in a moderate portfolio because that's middle of the road. Okay. Um, and so I hope that as January goes on, the first quarter goes on, that I can bring you a little bit more breadth in terms of what we're doing with Roar Score. We've been doing a lot of stuff in the lab. I'm happy with it, and I'll start to figure it out. What I really would love to do is get to the point where you can have a Rob version of this portfolio, okay, which is very much informed by the Roar scores. But, and then by the way, for those of you who are new, Roar scores it's just an automated version of me looking at charts for 40 years. We distilled it down. I had some help from a firm by the name of PieTrade.com. You'll hear us talk about them a lot. They're going to have a tab in our sheet, in our Substack. If you ever thought to yourself, oh, um, it would be a lot simpler if I could just like go to an app, put like $100 or $1,000 or something in there. They won't even charge me a fee right away. And when Rob makes changes to his portfolio, it maps over to mine. I mean, that's what PieTrade does. They're far from the only one, but the only ones at this point that I'm working with. And both portfolios are there, so you can copy trade, as they call it, my portfolio if you sign up at pietrade.com, and you'll hear more about it from that. I am a sort of arm's length research model provider that gives them the trades, and then they are an RIA and brokerage firm with interactive broker accounts, things like that. And they're basically onboarding people right now just to be kind of the initial adopters with a token amount of money. Very different than probably months to a year from now, where people will be using them the way they would use maybe a Schwab, Fidelity, Interactive Brokers directly, et cetera. Okay, so I'm going to spend a lot of time on this to the extent that you would like me to. Not today. Today I'll just kind of breeze through because there's a couple of things in here. So what is this? If you're not sure, it's the most and the least that I'm going to have. You notice there's no zeros here. Okay. This is, if you will, sort of like I don't know if I call it a permanent portfolio, but it's definitely a fixed basket of ETFs. 5 on offense, 5 on defense. And there's a minimum that I've applied to each one because I do not want to play the game of, oh, gold looked really bad. Then all of a sudden in a week, it's up 20%. So I'd rather have a little bit of gold all the time, especially with this one, the wild card spot. VIXI is long volatility. And so even a 1%, if the market were to have some Armageddon wake up one Monday and yen carry trade or whatever, you can fill in the blank, okay? If it were a real blank show, even having 1% in this will all of a sudden go from being this little tiny 1% position to probably acting like a 5 or 10% hedge on the equity exposure, just like that, because VIX volatility will blow out. It's around 15 right now, the VIX. That's basically everybody saying, we don't care. Stocks can't go down. No, stocks can't go. No, I'm telling you, stocks can't go down. I'm just playing a role here. But that's the attitude. That's the attitude of a 15 VIX. And that alone is why I increased this position from 2 to 3 this week. At the same time, play offense and defense at the same time. This is only 3% of the whole portfolio. The whole thing could go into the tank and it would cost me 3%, and that wouldn't happen overnight. Whereas I've got a lot more money over here. And I kept the Qs the same, but what I really wanted to do was increase the Dow. The Dow just looks like the best of the bunch right now. So I wanted to express that with an overweighting. It's at 30%. What does that mean? Well, it could go up to 40, but it's got an off of 20. So I would say the NASDAQ from a risk standpoint looks about average at this point. The Dow looks a little above average, but I'm also factoring in that I've got an above average hedge. So somebody used to say, a financial advisor that used to we used to run money for, and he said, "Oh yeah, that's Rob. Always invested, always hedged. Always invested, always hedged. That's it." But part of the benefit, I think, of what we do and how it's not a typical service is, yeah, I can spit out buys and sells for you. But I mean, and I'll go to those questions. But for any stock or ETF you ask my opinion about, there's another question. Because every single one of the ones that you asked about, I would say, yeah, you could own that. But how much? Owning 5% in gold is a lot different than owning 20 or 30% in gold. And 20% is my cap here. I'm nowhere near ready to buy 20%. If it had moved a little bit more slowly, maybe I could have gotten there. But okay, this is a conservative portfolio that first does not want to lose. If this thing has a peak to trough drawdown of more than 5%, I might just throw in the towel. And I'm recording this, okay? Peak to trough 5%. Okay. If I had $100 in the account and drops to 95 at any point, no. If it gets to 110, you know, it better it better not drop 5%, more than 5% from that. Okay. That's risk management. Well, Rob, what if the market falls 37% like it did in 2008? S&P was down 30, 37. NASDAQ has had a 75% decline in a little over a year, back in 2001. What if that happens? So what? I'm not tracking the market up and down. I'm managing risk and making as much as I freaking can after I've accounted for avoiding big loss ABL. So in that case, the answer is the same. No, 5% is my maximum. In fact, a portfolio like this with the volatility in it, with the ability to hedge interest rates, with at least the possibility that gold can run amok, that there's a Bitcoin in here and commodities, and the fact that I can take these equity positions down, okay, I could go 2% across the board, think about it. And this is the type of thing I'll talk about a lot, but I'll want you guys to start asking questions and learning here. Okay. I just do not think that there's anything in 30 something years of managing money professionally. There's nothing that I can deliver to you that will save you and make you more money between now and the end of your days than this structure. And it doesn't mean you have to have these in it. These can be any other ETFs that you want, anything. But this is portfolio management, and this is investment management, and this is how you get retired and stay retired, especially stay retired. So let's think of the worst case scenario here, and then I'll move on. The worst case scenario, as in, well, because I get these questions in Seeking Alpha articles all the time. Well, it doesn't matter because all stocks go down in a bear market, you're saying. So I guess you're out of luck, or you're just going to have to run to cash and figure out when to get back in. Au contraire. If I wanted to, and I don't think I'd go this far, okay, but I'll tell you what I did in 2020. This is how I pulled a rabbit out of a hat and made 2.5% when the market was down 34. And then before and after, I've had a similar experience close to break even. I mean, those of you who were in the club earlier this year, market fell in March and April. What was it, 20%? Okay. The portfolio I was tracking at the time had a lot of option collars. It was a little too complicated. So now I just answer questions about option collars, and I write a lot of articles about it. How much did my main portfolio fall when the market fell 20% in February 19th to April 8th, I believe are the dates? Zero. It was right around break even. Okay. Now, that is not magic. That is not being greedy and being willing to not perform anywhere near the market when it's up 20 or 30%. But you could just easily say, you know what? I want offense and I want a little bit of defense. Same thing with, the 2 ETF portfolio. You can say, I never want to have less than 50% in equities. So you're always going to have at least that, and then allocate the rule score to the rest of it. So that's how you get to 55 now. Or you could say, you know what? Yeah, I could go to zero. I could go to zero equities and I'd be okay with it. Or you can come up with any other iteration you want. ETF yourself. So in a parade of horrible situation, I already know what I would do. If it was a situation where I'm like, the market's down 5%, but given what just happened, dislocations, hedge funds blowing up, VIX is at 28 on its way to 88 all-time high or something, okay? You don't have to look very far. This thing's going to fly, at least temporarily. You have to be very careful because it moves like crazy. It's like a put option, okay? That's for sure. You can go up to 70%, at least I allow myself to go up to 70% in bill, okay? And depending on how interest rates are going, either bonds are going to be rallying in price or they're going to be falling in price. So I got that covered either way. So I could literally own 2% of every one of these, and that's the 10% of my portfolio where I'm taking risk. This is not exactly because I was a little bit more freeform, but this is exactly how I navigated 2020 and made 2.5% in a down 34 in 5 weeks. In 5 weeks. Okay. Now look, it might be ancient history now. I'm not talking about track record. I'm talking about, do you have the players on your team to win a championship, even if you get to the Super Bowl and it's pouring rain, okay? And you didn't expect the field to be in such bad conditions. The best NFL analogy I can come up with, playoffs starting this weekend. All right, so that is a little review of what's on my mind. I'm going to simply point this out because some of you are new. If you want to go any deeper, you can, and we have this on the site, etfyourself.com has all these resources available for you. I'll probably devote a whole period to this, but I have to say the list is shrinking. The list of what matters is starting to shrink. I mean, even Dow and equal weighted S&P are moving together. I'm starting to think that it's like nothing but AI stocks and other stocks. Those are the only two ETFs that anybody ever needs. I hate to say it, but that's what happens when you have algorithmic trading, index funds dominating, et cetera. So anyway, there's a lot of other places that you can invest. I've given you kind of a breakdown here. Uh, and then these are the ETFs that go with these. Okay? So I wanted to point that out again to start the year. Now, let's go to your questions. I'll get to these, but feel free, and you can always unmute yourself, and happy to talk to you live too. Okay, let's see. Oh, good. One vote for the 5 o'clock. Okay, I kind of like it. It kind of feels good. Um, let's see. Let's see. Okay. Wondering if you're still trading any individual stock. Oh, I'm trading individual stocks, but that's the thing. I'm trading them. Okay. I am, um, and not many at this point. And let me show you why. Okay. Uh, so at the aggregate level, here's the S&P 500. There it is, going nowhere for a while. Look, it's peeking its head up here. This is good. Here, let me make this a little easier to read. I'll just make it a year. Okay. There's nothing going on here. Nothing other than a very slow, continued rise, which is probably losing its pace. What I want to buy as a technician, and that's what I am at the end of the day, what I want to buy is I want to buy this. Okay. I want to buy a true trend change. And even that wasn't because the PPO has to go through zero here. Okay. I want to buy, like, this is where I'm getting a little more aggressive. Here it's kind of like great. I mean, what do they say? You again with the sports analogies. I'm standing on third base. I think I hit a triple, but no, I just had a great tailwind of a stock market. So, and if you look at so many parts of the market, like, oh, I'm diversified. I have SPY and Qs. No, same thing. Same thing. Oh, but it's okay because I also own XLK for technology. Okay. Yeah, same thing. It just went up a little more and went down a little more. Okay. And just too much of the market is like this. Too much of the stuff that counts. Um, let's see. I will get to some of the others. Okay, so Amazon was one stock somebody asked about. Uh, so this is actually, I'm really glad that you brought this up, Steve, right? Okay. The reason I'm glad is because I think that this is one of those situations. If I run through the Dow before we're done here, I could show you what I mean with a few other Dow stocks, but they look the same. There are some stocks that have, done a little spiky here. Okay. Uh, but what I have to ask myself, is this going to go up? I mean, I never know, but well, I wouldn't be surprised to see it go and challenge an all-time high. And great, that's what about 7% return? Okay. Um, it's okay. It's okay for a trade. It's okay if you buy a call option on it, or you, like, to me, the way I would look at Amazon, I do no, I don't think I own Amazon. I'd like to own Amazon for the long run, but at these valuation levels, I can't think of a single stock. I mean, again, I'm going to go through the S&P 500 probably tomorrow. So, and as a matter of fact, I am going to do this. In fact, I'm going to do it if for no other reason than because I think people want it from me. Um, I will probably go and find a list of 20, 30, I don't know, maybe 40 stocks, take really teeny tiny positions in them and basically say, hey, this is like my venture capital fund, except they're S&P 500 companies. And maybe some of them will be even smaller. I'll basically say, here, close my eyes. Hope these things will go up, in in 3 years. I did that. Some of you might remember if you've been in this for a while. I did that about a year ago. Then what happened? The whole tariff thing. And all stocks went down. Then all stocks went up. And I was like, okay, stock picking's dead for a little while longer. And it still is, but that doesn't mean that I can't come up with something to say, hey, you know what, my not for nothing, but these are the stocks that I think have the best shot, and gradually I'll whittle them down, and maybe I'll write about this so you guys will see. But I got an idea in the old noggin. So Amazon's where it peaked back in February, but there's not a lot of room. If I run a so you I mean you can make a trade, like I would most likely, I don't know, I might buy like a triple. I'm not telling you to do this by any means, but I would probably take a really small position in like a 3x ETF or something like that, um, because I just want to put a little bit of money to work, and hopefully it pops 7% and I make 20% on a small amount of money, really small. And if it went the other way, I wouldn't be that concerned. If it was down 17% on earnings and this thing got cut in half, I wouldn't have enough money in it to say, oh, I shouldn't have done that. Okay. Take big risks with small amounts of capital. Okay, let's see. Amazon. You have a portfolio with Chase and Exxon up on Seeking Alpha. What's up? You will have to show that to me. I am trying to remember where that would be. I mean, if it's up on Seeking Alpha, it could be a very old article. I mean, I do write about stocks. I will again. But yeah, if you can point me to that, that'd be great. Okay, let's see. Delve into how you would hedge your bond ladder if rates go up. Yes, yes, yes. Okay. Let me just see. I'm going to come back to that in a sec, just see if there's ETF and stock questions. Explain again why you don't have any international ETF. Ah, yes, yes, yes. Okay. All right. Why no international? That's why I have this. Okay, I put this in the article, but not everybody follows us on Seeking Alpha. This is a great chance to explain this. So what am I looking at here? I'm looking at 1 month total returns, meaning every day it says, what'd you do the last month? Okay, so if I'm looking here, let's just take here. So through yesterday's updates overnight. Okay, but the month ended yesterday. EFA was up 4.3, Dow was up 2.25, equal weight S&P up 178. Okay, now let's add back in S&P, but really, I mean, the S&P I only use in the 2 ETF portfolio. So let's see here. Let me get rid of SPY. Okay. So the way I do this, all right, the Qs and the Dow have a recent history of not being quite as correlated. And you can see some of it because you can see when these are, again, rolling 1 year returns. I'm only going back a year here, but we go back 3 years. Okay. Just visually, you can see that one of these things is not like the other, like the old song. Okay. If I take that away, they look a lot more alike than they do, and they still look a lot alike. But you get some highs and lows with this because that's the AI trade, which is captured mostly in the NASDAQ. So now you take that away, all right? Or another way to look at it is, okay? So these are rolling 1 month periods, and maybe to make it a little more visually appealing, I'm going to do this. 3 month total returns monthly. Okay. Well, what do you have here? Q's way ahead. Q's a little ahead. Q's way ahead. A little bit of a mix here. Okay. Q's way ahead. EFA on a 3 month basis, I'm not even going out longer. On a 3 month basis, Very powerful tool, I think. That's why I stick with Y charts for now. So this is the only period other than this, but since this point, so almost 3 years now, there are virtually no periods of 3 months, where EFA beat the Qs. So, when you have, and frankly, it didn't do that well against the Dow either. All right. So, like, why do I need, if there's a case to be made for, international stocks are going to do so much better this year. Okay. I mean, look, they are taking off a little bit. Okay. More so than the others. And I know there's a lot of money, kind of piling into this, but it kind of looks the same as the others to me, just a little bit more beta. In other words, it's directionally just like this. See, it's like the same chart. Same chart. I was thinking in my mind's eye that the Dow maybe wasn't. It's same thing. Why? Because this is how money moves. It moves in huge blocks by lots of investors that are way beyond, our combined wealth on this call by a factor of like a zillion. Okay, no matter how much money any one of us has. So that's the problem. The other thing is, and this is what I wrote in the article, I have a sneaking suspicion. Actually, this is not a great, because this thing had a distribution, so it screwed up the chart. Hold on a second here. Let's see if I can get US dollar. Can I get US dollar index? Yeah, there we go, the Dixie. Okay. So, wow, international did really well the last year, Rob. Yes, it did for the first time in a while. Did any of that have to do with the fact that when you buy international stocks through an ETF, you then have to factor in the currency, unless it's a currency hedge, but most of them aren't. You have to factor in the currency. So the dollar index went from 110 to 98. Well, doesn't that happen all the time? It's the dollar. Isn't it volatile? No. The dollar has been remarkably strong for a very long time. And it's only a couple times here that it's dipped. The dollar being down 15% from where it was in 2022, I have to go back and look and see, is this something? Okay. Um, that has usually not been a good sign. Okay. Uh, Sometimes it can be, but the way things are going now, U.S. credibility in question, et cetera, it's already, and this is a little bit too long a chart, is monthly, but look at what happened. Okay. The dot-com bubble went on even longer than it otherwise might have because the dollar just completely tanked. And so to me, it's not saying that international stocks are bad. I'd never say that at this point. It's that basically, if you want to do a simple formula, US stocks plus dollar impact equals international stocks. That's the summary. So you take the dollar and you goose up or down. In this case, you goose up because the dollar was falling 10% during the year. So international stocks probably look about 10% better than they actually do. So what would I do? Oh, I might eventually get down around international stocks. It doesn't mean that you can't. You do whatever you like. But to me, if I think that, dollar weakness is a problem, why would I be sitting in international stocks when I could have had this in gold as the anti-dollar play that it tends to be? Bitcoin might even be an anti-dollar play at some point. I think right now it can't make up its mind. Bonds can be the anti-dollar play. Um, this is what I'm looking for. Okay, this is shorting the bond market, which, by the way, is going to answer the other question. Easiest way to hedge rising interest rates when rates go up. In fact, easier to show it here. tackle all these and I'll look back to see what other questions you have. Let's do this. Let's do this. Let's take the 10-year Treasury yield. And let's take, TLT. And let's take TBF. And let me get this out of here and do this. Okay. Oh, that's right. I'll do it this way. It'd be easier. Oh, okay. Hold on. That's strange. I thought they would all show. There we go. Okay. All right. So, uh, what are we looking at here? Well, it's the last 3 years. And this is, I'll take these one at a time here. This is the rate on 10-year bonds. Okay. It really is this. Divide this by 10. So it's 417, 418. All right. It went all the way up to here. Then we had, matter of fact, you can see it here, the disaster that was 2002, where stocks fell and bonds fell too. We could be in for that again in 2026. Would not shock me in the least. Well, so you got that. What happens to bond prices? That's not going to work very well. Let's see. Let's see. It's hard to tell because the move was so big. Let me see if I can get that. Yeah, okay. Yeah, generally speaking, okay, they move opposite each other. All right. So when interest rates go up, this is the 10-year, but similar. When interest rates go up, bond prices go down. When interest rates go down, bond prices start to recover. Well, when people are concerned about U.S. debt deficit, congressional inaction, walking into sovereign nations, whatever, okay? Whatever it is we're doing, doesn't matter what my opinion is, it matters what the market's opinion is. And if the market comes to say, given the situation you guys are in, and you haven't licked inflation yet, and you owe all this money, and you're rolling over your debt constantly and buying T-bills with it. It's like, no. You are going to have to pay us a higher rate of return on the bonds than 4.18% on a 10-year. Try 518, maybe even 618. And if that happens, okay, the dollar will likely be feeling it for a while, okay? But the one thing that is clear is that bonds over here, bond prices, okay, will really come down. Rates have gone up a little bit recently, and so bond prices are going down. I mean, this is including the income. Okay. If you had invested in long-term bonds 3 years ago, you'd still be down 5%, including the 4% or so, 5% that you were getting in yield. All right. So what do? Rates are up. International stocks, at some point, the equity market says we don't like stocks no matter what they are. And so that doesn't work anymore. What do? Well, that's why this is here, because it does the exact opposite. In fact, I'll go back a little further. Okay. And let me go back to the beginning of 2022. All right, let's take it peak to trough. Okay. TLT. So, and I remember at the time, people were pouring money into this thing. Okay. Oh, I got to buy long-term bonds. Like they didn't know that if the rate goes up, the price goes down. That's how bonds work. So a 41% decline in a bond ETF where you don't even own the bond, so you can't, like, they don't mature for you over time like a ladder does. So, but if you look in the gray box there, when it was up 41%, TBF, a little bit of a levered effect, but not much, like 25% or something, okay? Cover their coupon. 73%. So, you know, let's go back to the old chart here. Okay. Good. You're starting to see it, aren't you, David? Right? Hopefully, nobody will have to play this thing over like 20 times. So, what did he say again? What is the which way do bonds go? And that's fine if you do. That's why we're memorializing it. Okay. Um, Maybe we'll cut this explanation out and we'll put it, we'll put it in something that everybody can learn from. So that's why this is here. That's why this is here. I'll be doing a lot more writing about this because the questions I'm getting, especially on Seeking Alpha commentary, is people are looking at it and saying, "Well, why don't you have this one in here? Why didn't this make your 10?" Why? Because I'm on a mission here. My science project in 2026, if you will, is to try to figure out, for those of you who remember the game show Name That Tune, I can name that tune in 8 notes. I can name it in six. Well, I can try to name it in three. And what I'm saying is, I can get just about any investment result that I want over a period of a few years. I'm down to, I think I can do it with 10 ETFs. It wouldn't surprise me if I got down to 4 to 6 at some point. I don't think it'll ever get down to two, but two will get you a lot of coverage. Okay. So that's my point. Investing has become, I hate to say commoditized. Okay. Insight hasn't, I hope. Prefer not to be, out of a semi-retirement job, but yeah, but that's the issue. Okay. So now, what will you want to buy? In fact, let's take this same time frame here, and I'll finish up with this and see if there's any other questions, and we'll call it. Uh, let's see. Let's go to the end of 22 because it really was pretty bad. Here, I'll go to here. I want to look peak to trough because I'm trying to make sort of emphasize the point here. Okay, well, that couldn't have gone much worse for TLT. Hey, how's your bond ETF doing? That safe thing that you have all that money in. Oh, it's down 36% this year. What? I thought it was bonds. Yeah. So, did anybody tell you that you could basically short the bond market? Rates go up, you go up. Okay. I don't remember offhand what gold did here. I didn't think it did a whole lot. Yeah. See, gold was not the saver. Oh, you could just buy gold. Okay. Well, I don't know what Bitcoin did back then. There weren't ETFs available, but let me see if I can find. Here's the Bitcoin price. Okay. Well, Bitcoin didn't help either. Why? Because it was linked to the stock market. So I guess my point is I have 10 great athletes, I hope. I'm starting to doubt whether all 10 are, but I have some great athletes to go into this portfolio with. And by the way, if this doesn't work, it probably will. And that's why they're both in there. They're not identical, but they will offset each other. Shorten this up a little bit. All right. To coin Danny DeVito from his movie with Arnold Schwarzenegger many, many years ago, which was called Twins. They played twin brothers, long lost twin brothers. It's like looking in a mirror. It's like looking in a mirror, isn't it? Mirror image. And it's different degree you can see. But again, I go back to here. This is the power. This is why I created the 10 ETF portfolios, that I got to start minimizing the other stuff. But of course, as you see, I'll answer whatever you want and I'll coach wherever you want. If a bunch of people said, "Hey, can you do a session on, best stocks in the S&P 500?" Great. We'll devote a whole session to it. If one or two people ask, it's hard to do it, but It was a lot of group consensus. Maybe we can put out a survey and say, here are some topics we're thinking of doing, that type of thing, and we'll vote. It is a democracy here. So anyway, I try to cover it a few different ways, but yeah, you got these two. This one I'm not so sure about is acting too much like the Dow. Um, and if that's the case, I have to find something else to go here. That's why I'm minimizing it now. Commodities are own animal, Bitcoin's own animal. I've got this and this that play off each other. I've got the cash, obviously. I've got this thing for those wild volatility moments, and I've got gold. And maybe I could use more, but here's the challenge that you should have for me this year in these sessions or in the chat, whatever. All year, I'd love for you to keep challenging because I don't know for sure. I'm going to find out as time goes on. You challenge me. Say, hey, Rob, what about this one? Wouldn't that like does your 10 does owning only 10 ETFs and allocating between them, does that does that mean that you'd miss out on XYZ? Oh, you'd miss out on uh, consumer staples, or oh my God, energy stocks are doing so well. It's okay, we have the commodities and it's 50% energy. Home builders are doing so well. Well, maybe home builders do really well, but guess what? Home builders tied to the interest rate cycle, I have the bonds either way. So if home builders are, and this is what I'm going to devote so much of my research to this year because this is the best learning. My whole thing, my legacy, if you will, is to translate all this stuff about managing portfolios for yourself out to anybody who wants to be a part of it. And so that's that's the thing. Dogs of the Dow, yeah, dogs of the Dow. I mean, that's okay. As a matter of fact, the dogs of the Dow strategy, I don't know. Let me remember. I haven't looked at this one in a little while. It's not a dog. I mean, there is a Dogs of the Dow ETF, but there is wait a minute. I think there's DJD. Okay. I wrote about this on Seeking Alpha a couple times. So DJD is the Dow 30. There's an equal weighted Dow, EDOW. There's DIA, which is the regular Dow weighted by the price of each stock, the dollar price, not the size of the company. And then there's this one. Okay. This is the Dow weighted by dividend yield. Dividend yield or dividend amount, I can't remember, but basically the size of the dividend. And so there's a few stocks that aren't in here because they don't pay dividends. The rest of them are in here. Nvidia is probably a tiny, tiny portion of this because they barely pay a dividend, like just enough to make some screens, probably. Uh, but does this chart look familiar? If it doesn't, let me remind you. It looks like every equity chart we looked at so far. So yeah, dogs of the Dow, great. But this is like, if you don't mind, this is I wouldn't call it a game, but it is a little bit of a game. It's like, stump the geek, whatever. Okay, try to stump me. Like, is there something? And I know there's going to be stocks individually, okay, and we'll go over that too. But maybe that's our project for this year. Let's see, because I would love to find something else, but I'm struggling to find something that gives me consistently and remarkably better results than I'm likely to get from focusing on 10 ETFs. And then I put it back in your hands and I say, okay, these 10 or 10 others. Doesn't matter to me. Like NASDAQ and Dow, just keep S&P. You want S&P and top 50, top 20, you plug in. And I'll teach you as much as you want in these sessions how to plug in and how to build your own portfolio, how to, wait for it, ETF yourself. So that's the issue. All right, good. Steve, I see that note. We'll check on that. That's probably something we didn't take off the site. Let's see. Same thing for gold. Falling dollar helps gold. Yep, absolutely. So, you know, uh, I guess if there's any other questions, just pop them in right now. Otherwise, we'll close up here. But as I see it, we've entered an era here, and it will intensify in 2026. Everything's just binary. Everything is to some degree commoditized. Risk on, risk off. And you have splinters from that. But what I'm looking for is not every possibility. I'm looking for, can we cover 90%, even 80% of the needs of a broad cross section of do it yourself investors with 10 ETFs? I'm going to see if we can. And occasionally I may bring stuff in and out. I might drop RSP at some point and bring in something else. But the problem is I don't know if I can find the other one. And I'm committed to having 10 in there. So we'll see. We'll see. But thank you. The questions helped drive me toward this discussion, which is a perfect way to lead off 2026, because I think it's the year of building and maintaining your own portfolio where you decide what the names are, you decide what your normal or neutral weight would be. You decide what the overweight, underweight is, and put some guardrails on for maximum and minimum. And make your own decisions about how often you want to trade. I run this weekly. I update it weekly, and I'll trade it either very end of the day Tuesday or first thing Wednesday morning on my own account. I mean, we'll see. We're recording this January 6th, okay, 2026. You know, Lord willing, we're all here doing this again a year from now. And if we are, it wouldn't surprise me if I said, as much money of mine as I had in these types of portfolios with the trading and the ladders and the collars and stuff kind of as the side dishes, especially the trading. I do a lot of trading, but side dish, not play stuff that can do really well because I've learned how to trade a bit, but again, you should be throwing your questions at me constantly. Let me see. Multi portfolio idea past you. Yes. Great. All right. Matt has been very patient. I am going to turn off the compute the recording, and I'm going to do that. Hold on a second. Turn this off.